Today we're really setting aside the standard economic textbooks.
We really are.
We're moving beyond that predictable dance of, inflation and interest rate cycles. Our focus is a really profound macro shift, and it's centered squarely on the year 2026.
Right. And crucially, this shift is driven almost entirely by one inescapable force.
Yeah.
Political necessity. That's the absolute core of it. The mission today is to unpack these arguments from two of the market's, real heavyweight strategists, David Wu and Michael Hartnett.
And their thesis isn't just compelling, it's a dramatic structural reassessment of the global economy.
It is. They're arguing that the overwhelming need for the current U.S. administration to secure a political win in the upcoming midterm elections is forcing a complete, almost radical overhaul of U.S. policy.
Both economic and foreign policy.
Both. And this isn't about gentle tweaking here and there. This is aggressive, targeted intervention that fundamentally reshapes asset pricing across the board, from crude oil all the way to gold.
Okay, so let's really unpack this because it deserves some depth. The central tension here, as you're pointing out, is that the market is still, for the most part, priced for a simple reinflation scenario.
A soft landing, maybe, a bit of a slowdown, the usual stuff.
Exactly. But according to these sources, that whole expectation is completely outdated. We're moving towards something else entirely, a deliberately engineered economy.
An aggressive, politically motivated pursuit of, deep deflationary measures.
Coupled with a massive targeted stimulus. And the whole project is packaged under this single, very resonant banner of affordability. It's an artificial boom by design.
And that engineering has profound geopolitical consequences. Wu hits us with this foundational shockwave right away. He predicts that based on rules international order, the system that's defined global trade and stability since World War II.
It's basically ending.
It's ending. And why? Because the U.S. is choosing unilateral power politics, driven by domestic political survival over its traditional role as the system's guarantor.
Which requires a completely different investment response, a radical one. Hartnett encapsulates it perfectly with his strategy. Long boom, short bubble. We are tasked with trading the politically manufactured prosperity, that's the boom, while aggressively hedging the geopolitical instability and the asset overvaluation that comes with it. That's the bubble.
Yeah.
So you have to be long the political cycle and short the structural risk.
That's the game.
That distinction, trading the engineered boom versus hedging the systemic risk, I think that's going to define our entire conversation. But before we get to the trades, we have to understand the pressure. Let's spend some real time on the political landscape because, as the sources keep emphasizing, this is the bedrock of the entire 2026 macro outlook.
It all starts there. This is where it gets, I think, structurally really interesting. To forecast the market moves, you have to start with the political calculus, and the sources are absolutely definitive. The 2026 midterm elections are creating this massive, almost existential pressure cooker for the current administration.
This isn't just about losing a few seats. This is about maintaining the ability to govern at all.
The pressure is immense, and you're right, the stakes couldn't be higher. We're witnessing what they call a throw the kitchen sink strategy. It means the administration is ready to deploy every single economic and geopolitical tool it has.
Purely to survive politically.
Purely in the pursuit of political survival and maintaining control of Congress. And that overrides any traditional policy ideology completely.
So let's get specific. Why the desperation around the 2026 midterms? We all know midterms are usually tough for an incumbent, but why is this particular election being framed as this absolute do-or-die existential threat?
The vulnerability isn't just electoral, it's structural. The source material is very clear on this. If the Republican Party loses control of one or even both chambers of Congress in November 2026,
the second term is essentially over. It faces an immediate near-terminal crisis. We're talking about the nightmare scenario. Ceaseless subpoenas, investigatory paralysis, the total inability to move any legislative agenda, and the constant threat of impeachment proceedings.
That constant destabilizing threat. So maintaining control of Congress is the essential firewall against, frankly, political self-immolation and a complete legislative breakdown.
And this aggressive interventionist approach, it's all necessitated by some genuinely alarming approval numbers. They're telling the administration they just can't run on the status quo. What are the specific deficits driving this?
The numbers are really staggering. They point directly to a crisis of voter confidence on these core kitchen table issues. Trump's overall approval is hovering somewhere in the, 40 to 43% range.
Which is low.
It's very low. And critically, If you compare that to historical norms for incumbents, especially one who just won a general election, that represents a historical deficit of about 20 percentage points. That gap is almost insurmountable without some kind of dramatic, visible action.
But let's zero in on the economic metrics, because that's what this deep dive is really about. The sources cite two key economic approval numbers that are actually far worse.
Exactly. I mean, 41% approval for handling the economy is already concerning, but the real flashing red light is the metric for handling inflation.
Which is at
a dangerously low 36%. When only about a third of the electorate approves of your handling of the most immediate financial pressure they feel, the cost of goods, you have a crisis.
These figures are basically signaling that the voter consensus is that the economy is not affordable.
It's not. And that demands immediate and very politically visible policy reversal.
So the political machine is in full-on emergency mode. And there's this quote from the White House Chief of Staff, Susie Wiles, that really underlines the unprecedented nature of this effort. It absolutely does. Her statement, as it's referenced in the sources, makes the objective crystal clear. The 2026 campaign effort will equal the intensity, the resources, and the focus of the 2024 general election year. That's unheard of for a midterm.
It's exhausting. It's an unprecedented level of coordinated political warfare being planned for a typically quieter cycle. It just signals that this is not a policy choice. It's a political mandate that's overriding traditional governance. And this political mandate has been boiled down to a single, very communicable and highly potent focus: affordability. Precisely. Political survival hinges entirely on winning the affordability debate. They have to demonstrate a clear, tangible, and immediate improvement in the cost of living for middle-class voters.
And that necessity, more than any abstract economic theory, is what drives this shift toward these radical deflationary measures.
Exactly. Targeting energy, housing, consumer prices. If they can flip that 36% approved trading to something closer to 50% by November 2026, they win. Every single policy we're about to discuss, from central bank actions to geopolitical oil strikes, serves this single political purpose.
Which means the market can't just sit around and wait for the Fed to decide its path based on abstract data. The market is now reacting to a political need to engineer a very specific outcome.
Lower funding costs, lower gas prices, and higher disposable cash flow for voters.
All delivered by a very specific deadline.
That's the crucial frame we have to adopt. We are analyzing interventionism as a targeted political policy tool. And Hartnett synthesizes the sheer breadth of these interventions. It's a multi-pronged approach across monetary policy, geopolitics, trade, specific industries.
All designed to secure that one critical electoral advantage. This level of coordination is, it's fascinating. It sounds less like standard government policy and more like a massive coordinated market manipulation effort.
Designed to hit every cost column in the average American's monthly budget all at the same time.
So let's break down these policy tools they're reportedly using to manipulate prices and funding costs. Where do we start?
Let's start with monetary intervention. The goal here is explicitly to lower funding prices. Hartnett notes this is being pursued through a de facto form of quantitative easing. QE?
But not the vague QE of the past.
No, this is very targeted. The sources specifically mentioned the purchase of Treasury bills, T-bills, and critically, mortgage-backed securities, MBS.
Okay, T-bills, I get. It helps fund the government's debt. But why specifically target the housing finance market with MBS? Why that?
Because housing cost is the single most visible and painful inflationary component for middle-class families. It's what people feel. Lowering MBS yields has an immediate impact on the 30-year fixed mortgage rate.
Which is the benchmark housing cost metric for voters. It's the one they see. So by keeping those rates artificially low, they're addressing a primary affordability pain point. It's a direct visible attack on two major inflation centers, government funding and consumer housing expense. This is highly political QE. And these interventions, they don't just stay in the domestic finance world, right? They immediately stretch out into global supply chains, into high-stakes geopolitics.
Absolutely. Which brings us to the most disruptive tool. Next is geopolitical intervention. This is the highest leverage move they have. Policies, like the recent highly disruptive action concerning Venezuela, which we should really detail in a bit.
We will. They're aimed strategically at driving down a single commodity price, crude oil. And the sources stress the motivation is explicitly price control for domestic political consumption, not foreign policy, ideology, or humanitarian goals. We also see this pivot in trade policy, which has been such a lightning rod for this administration historically.
Correct. The sources indicate a shift in trade intervention toward actually reducing tariffs.
which seems contradictory.
It might seem that way given the past reliance on them, but it aligns perfectly with the goal of reducing consumer cost burdens. Tariffs are fundamentally a tax on imports, and that tax is largely passed on to the consumer as higher prices.
So reducing them is a quick lever to pull for visible cost relief on manufactured goods.
It is. And moreover, as we'll discuss later, the tariffs they've already collected provide the funding mechanism for the stimulus package. It's a completely closed political loop.
And finally, there's direct intervention in specific inelastic sectors that really hit the pocketbook hard. Yes, industry intervention. The plan notes direct actions to intervene and lower the prices of specific goods and services that hit the middle class the hardest. Pharmaceuticals, housing, insurance, and electricity. So they're going after everything.
Everything. This likely involves increased regulatory pressure, maybe price caps or subsidies, anything to create an immediate, measurable impact on the CPI components. When you look at the whole scope, from interest rates to gas prices, utility bills, medication costs, it's an aggressive, coordinated, whole-of-government effort to engineer deflation for political gain by November 2026.
The sheer coordination of that strategy is what makes it so, well, alarming. But if we follow this logic of political intervention, the single largest target has to be the one voters feel every single day.
The cost of gas.
Exactly. So let's shift our focus entirely to how they plan to pull that lever, because this energy intervention is the most disruptive component of the entire strategy.
The energy price attack, as outlined by David Wu, is arguably the ultimate transaction theme for 2026. It merges high-stakes geopolitics with immediate voter relief. This isn't just an incidental policy. It's an aggressive strategy aimed at slashing oil prices, no matter the longer-term geopolitical cost.
And the recent Venezuela action is the centerpiece of this. The sources stress this move is purely transactional. We should really elaborate on why Venezuela is such a powerful lever in this specific context.
That's a critical distinction the sources really hammer home. Wu argues that the moves concerning Venezuela are fundamentally motivated not by, abstract democratic ideals, but by the direct strategic intent to bring Venezuela's massive oil resources back online.
To increase global supply and drive down the price.
That's it. We have to remember the sheer scale here. Venezuela holds the massive 18% of the world's proven oil reserves. Gaining influence over that supply, or even just signaling the intent to flood the market with it, is a massive, immediate lever on the global crude market. It's far more potent than just tapping the Strategic Petroleum Reserve.
And this strategy isn't just vaguely aiming for lower prices. There's an explicit, publicly understood price target they're shooting for domestically, which makes the whole thing measurable. There's a clear psychological target for the American voter. $2.25 per gallon gasoline. $2.25.
And the timing is everything. They need to achieve this critical milestone well before the peak campaign months, so specifically September or October of 2026. Hitting that number right before the midterms is seen as the single most effective, visible way to directly address that 36% approval deficit on inflation. Gas prices are the most immediate inflation barometer for the average voter.
Wait a second. Hitting $2.25 gasoline implies a massive, almost unprecedented drop in the price of crude oil. You're talking potentially down to $40 or $50 a barrel. That kind of collapse, dictated by U.S. political maneuvering, carries massive secondary risks. How do the sources suggest the administration manages that systemic financial risk while trying to engineer a boom?
That's the core contradiction, isn't it? The aggressive deflationary policy creates massive systemic risk. Wu predicts a dramatic shockwave in the crude market. He forecasts that this geopolitical strategy, if they execute it fully, will severely impact the crude oil market, potentially sending prices down to the $50 or even the $40 per barrel range by the end of the year.
So if that forecast holds,
then the linchpin trade for 2026 is structurally shorting crude oil. You're betting against its prevailing price strength.
But let's think about the secondary effects of $40 crude. That collapses the U.S. shale industry, which is highly leveraged. It would trigger massive defaults in U.S. high-yield energy debt, and it causes huge job losses in key energy-producing states like Texas and North Dakota. That creates an economic contraction in certain regions. Does the analysis address how the administration shields itself from those financial and, regional political costs?
The analysis recognizes this as a necessary sacrifice for the greater political good. The administration is essentially betting that the nationwide low gas prices benefit every driver in every state, outweighs the concentrated pain in the energy sector.
So they're willing to take the hit in Texas to win in Ohio and Michigan?
Basically, yes. Hartnett's advice to be long banks and long industrials suggests they expect the broader economic stimulus and the lower funding costs from QE to offset the credit crunch in the specialized energy sector. The strategy is to accept localized distress in the energy belt in exchange for broad national voter euphoria driven by affordability.
It's a calculated trade-off of concentrated pain for diffuse political gain.
That's cold, hard politics guiding macro policy.
Given the scale of this intervention, who are the unambiguous global winners and losers? Because this policy essentially declares economic war on specific global players.
The analysis is very clear on this. The biggest loser is unequivocally OPEC, the cartel that has long managed global oil prices. Their market control power, built up over decades, will be severely curtailed if the U.S. can unilaterally introduce massive new supply or just leverage geopolitical instability to threaten supply increases.
Their ability to manage prices and influence global economics is neutralized.
Completely. When the U.S. decides political survival dictates a price ceiling, OPEC's influence, as we know it, is basically over. Conversely, the biggest winners are the major oil importing nations. They see massive trade balance improvements and immediate inflationary relief.
And Ru names names.
He specifically names high-consumption economies like India and Japan, whose economies receive this immense structural subsidy from perpetually low U.S.-engineered oil prices. So we have the deflationary hammer, the aggressive attack on energy prices, creating affordability by cutting costs. Now we pivot to the second prong of the campaign. The proposed stimulus package aimed at boosting disposable income. Right.
This is where the strategy shifts from cutting costs to putting cash directly into voters' hands. This fiscal boost is the essential complement to the deflationary policy. The logic is clear. Cut costs, then boost income. You get maximized disposable income right before the election. David Wu projects a high probability for this, specifically 65% of a new, large-scale stimulus package being launched before the midterms. The political pressure alone makes the odds pretty high.
Significantly higher than average.
And what's politically brilliant here is the proposed mechanism for funding it. It connects the stimulus right back to the previous policy on trade.
The mechanism is pure political engineering. The plan is to use the vast revenues collected from tariffs imposed in the previous year to issue tariff rebate checks.
So it immediately reframes the tariff tax, which often hurts consumers through higher import costs, as a direct cash benefit.
Exactly. It transforms a perceived tax burden into a visible, tangible cash entitlement. And the proposed amount is substantial and highly targeted. $2,000 per person for Americans earning under $75,000 annually. So it focuses the fiscal boost squarely on the middle and lower classes, the demographic most susceptible to the affordability debate.
Precisely.
But here's where we need the technical deep dive. How do they get a large-scale $2,000 per person check through a divided Congress? Especially the Senate, where procedural hurdles usually kill major spending bills.
The key is the legislative maneuver. It involves political bundling and procedural engineering designed to bypass the filibuster. The strategy is to bundle the tax rebate with an extension of Obamacare subsidies.
Which is a key, non-negotiable legislative interest for Democrats that has significant support.
Exactly. By linking these two high-priority but ideologically diverse items, the administration can pass the entire package using a reconciliation bill. Okay, let's stop there and explain the reconciliation bill for a moment, because it's absolutely critical to the political timing here. What is the risk-reward of using that legislative tool?
Well, reconciliation is a procedural mechanism that lets certain spending and revenue measures pass the Senate with just a simple majority, 51 votes. It avoids the 60-vote threshold of the filibuster. So the reward is speed and certainty. Money hits bank accounts quickly.
And the risk?
The risk is procedural. The Senate parliamentarian has the authority to rule on whether a specific provision, like the tariff rebate check, is sufficiently related to the budget. It's a concept known as the Byrd Rule.
So if the parliamentarian rules against it,
it would immediately derail the political timing of the checks and could sink the whole initiative. The administration is betting they can make the case that using previous tariff revenue for tax reduction passes the test. It's a high-stakes legislative gamble designed purely to ensure the money hits voters' hands before the election.
Assuming the gamble pays off, what does this targeted stimulus, combined with low oil prices, do to the broader economic structure?
The intended economic impact is to radically redistribute spending power. This targeted stimulation for low and middle income groups, combined with the increase in disposable income from low energy prices, is expected to heavily benefit general consumer retailers.
Consumer staples and discretionary sectors tied to the lower end of the income scale.
Right. Wu suggests this dual boost, low costs and high cash flow, could actually reverse the prevailing consensus of a K-shaped recovery.
The K-shaped recovery being the idea that the wealthy recovered quickly while the lower and middle income segments lagged significantly behind.
Exactly. The goal is to make this recovery look broad, inclusive, and beneficial to the average American just as they're walking into the polling booth. It implies a rotation of capital into sectors that serve this demographic. We're looking at significant tailwinds for everyday retailers, maybe regional banks, as credit quality in the lower income brackets improves dramatically.
All thanks to reduced gas expenses and a direct cash injection.
The entire fiscal effort is designed to manufacture political economic success from the ground up.
We started this deep dive by referencing the end of the rules-based order as the foundation of Wu's analysis. And now that we've seen the sheer transactional nature of U.S. policy, the Venezuela move, the QE tied to midterms, it becomes so clear why that global stability is eroding. These aggressive, purely political actions send massive geopolitical signals that go far beyond the price of gasoline. This is about global security itself. This raises perhaps the most profound question of the entire analysis. What happens when the system's guarantor stops guaranteeing the system? David Wu is adamant about this. This transition means the U.S. is shifting from a predictable, treaty-bound system leader to a unilateral power politics player, where policy is decided by domestic political expedience.
That's it. This is the most significant macro change happening right now, far outweighing any changes in inflation data.
And this new reality forces every other nation to reassess its security, its trade, its diplomatic positions. It sounds like an immediate return to great power maneuvering, where alliances mean less and immediate self-interest means everything.
It is an abandonment of the traditional U.S. role. Wu states that when the world's most powerful nation acts solely based on strength and political necessity, rather than established rules or treaties or long-term alliances, the international system designed to protect smaller nations.
Things like the WTO, UN Security Council norms.
They cease to function effectively. That stability premium, which nations relied on for planning and investment, is just gone. It creates a global environment defined by uncertainty.
And the immediate result of that uncertainty is a sharp increase in global security anxiety. If the U.S. is unpredictable, every other nation, regardless of its size or alliance structure, has to hedge against instability. How does the analysis connect this anxiety to specific assets?
Geopolitical disorder immediately requires specific investment hedges. And we see three key asset plays that result directly from this new reality.
Okay, what are they?
First, you have long defense. The inevitable result of global security anxiety is that nations have to significantly increase their defense spending. They can no longer assume U.S. protection is automatic or unconditional.
So countries in Asia hedging against China, or countries in Europe hedging against Russia, they have to prioritize their own military capabilities.
Exactly. And this strongly benefits the defense industry sector across hardware, software, services globally. This is a secular, long-term trend driven by fear.
The next implication sounds particularly negative for developing economies, which relied so heavily on global stability to attract capital.
That's why the source advises to short emerging markets.
Good.
In this new era of power politics, small economies lose their traditional safety premium. They become much higher risk, the traditional convergence trade logic.
The idea that developing economies will reliably catch up to developed standards.
That idea fails when the underlying political stability that guaranteed their access to global markets and capital is eroded. And furthermore, many EMs are highly dependent on global commodity prices and dollar funding, so they're extremely vulnerable to the energy and rate interventions we just talked about. They just lack the institutional firewall to manage this disorder.
And finally, the classic hedge against a breakdown of trust in paper currency and government stability.
Gold. Long gold becomes essential. As the traditional dollar credit foundation, the trust in the U.S. as the stable global economic arbiter is eroded by geopolitical realism and these massive chronic domestic budget deficits. Investors seek hard, unprintable assets.
And gold is the ultimate one.
It becomes the core hedge against a disordered world. And Wu doesn't even rely on a catastrophic dollar collapse to justify the trade. He predicts gold has more than 10% upside potential simply because the geopolitical risk premium, the cost of insuring against global anarchy, has risen so dramatically. Gold is a volatility insurance policy when treaties fail.
Let's bring this down to the actionable level. We have political desperation leading to aggressive intervention and this resulting global disorder. How does Michael Hartnett translate these massive forces into a cohesive investment strategy that actually makes sense of the contradictions?
Hartnett's strategy is explicitly centered on rotation, not retreat. He acknowledges that despite extreme bullish readings, like the bull-bear indicator hitting a sell signal extreme of 9.0, which usually suggests selling everything, the politically engineered boom is real, it's powerful, and it has to be traded.
But investors have to be ruthlessly selective to avoid the bubble risk inherent in the overvalued parts of the market.
Exactly.
The core strategy is long boom, short bubble. We need to clearly define the difference between the two to understand the trade. What specific metrics distinguish the politically engineered boom assets from the speculative bubble assets?
The long boom means you're betting on assets that benefit from low energy costs, low funding rates from the QE, and direct consumer stimulus. These are cyclical, value-oriented assets tied to the real Main Street economy.
And short bubble.
Short bubble means aggressively shorting areas whose valuations are entirely reliant on speculative excitement, unrealistic future growth, high capital expenditure, primarily those second derivative AI plays that have run too far, too fast, without proving cash flow.
And Hartnett provides a specific two-part framework for this allocation, right? The Big Me configuration.
Yes. The long-term structural configuration is long-term, big EG, that's bonds, international stocks, which reflects the strength of non-U.S. importers and the cheapness of non-U.S. valuations, and gold, the geopolitical hedge.
And the more active part.
That's the trading MID component. That's mid-cap stocks for domestic cyclical exposure, short investment-grade IG bonds, and short USD, betting on dollar weakness as deficits balloon and the Fed keeps rates low. This framework perfectly balances stable, long-term hedges. The big with cyclical rotational value plays, the mid.
The long bonds component of the big framework is still profoundly counterintuitive to me. In an environment of massive fiscal spending and projected stimulus checks, every instinct tells an investor to short long-term government debt. Why does Hartnett advise long bonds here?
This is the most critical piece of strategic reverse thinking. The rationale is purely political and structural. The sheer scale of government borrowing is the driver. The U.S. Treasury needs to issue an astounding $1 trillion in new debt, mostly T-bills, within 100 days.
$1 trillion.
And to maintain buying pressure and prevent yields from spiking, which would immediately raise the cost of financing the government's entire Operation QE, becomes politically essential.
There's also the political timing aspect.
Exactly.
The sources note the specific political timing. The market typically tests a potential new Fed chair by selling bonds, which causes yields to rise in the 3 months post-nomination. The administration has to ensure rates are suppressed during that vulnerable political window. So QE has morphed entirely from an anti-recession tool to a debt management and political timing tool.
That's it. It's part of the dual constraints driving policy that only QE can resolve. The administration needs low CPI to win votes through affordability. At the same time, the Fed and Treasury need lower interest rates to prevent unemployment from rising above the politically sensitive 5% level.
Especially with youth unemployment already at 9%.
Right. The only way to satisfy both needs, low CPI, and low rates while issuing massive debt is to suppress yields. And that makes long bonds a necessary political trade, despite the massive structural deficit.
What about the rotation trade? Where exactly should capital be moving domestically if we're shorting the speculative AI bubble?
Hartnett advises a clear, aggressive shift away from overheated growth and into cyclical value. It reflects the broad-based, non-tech nature of this politically induced boom. The advice is to increase exposure to sectors that benefit directly from low funding costs and consumer cash flow.
So banks, real estate, REITs, materials, industrials, and small and mid-cap stocks.
Those are the classic cyclical winners. They thrive when rates are suppressed, and the middle class feels flush with cash.
And the market darlings, the Mag 7. Should investors just flee entirely?
Not necessarily flee, but the advice is to maintain but cut aggression. The sources note that the defense-oriented large tech stocks, the Mag 7, have already seen their performance plateau and actually decline since the late 2025 elections. They're still dominant players, but the easy exponential money has been made.
So the marginal investment dollar needs to rotate.
It has to. And crucially, investors are advised to aggressively cut exposure to second derivative or high capital expenditure AI concepts, specifically shorting the bonds of AI hyperscaler companies.
Why short the bonds of those AI companies and not the stock?
Because the bond market is often the first place to smell systemic risk. The growth projections for these hyperscalers are predicated on massive future revenue streams, funding huge capital expenditures now. If those projections slow down as competition heats up or hardware bottlenecks restrict growth, the highly leveraged balance sheets of these companies will be questioned first by the bondholders.
So shorting the bonds is a more sophisticated bet.
It's a bet that the high capex AI consensus is fragile and unsustainable, making it a perfect example of short bubble.
It's also important that even in this hyper-political analysis, they look back at history for perspective on hedging these kinds of geopolitical risks.
It's essential context. They cite historical data going back to 1939, and the assets that perform best 6 months after the outbreak of a war confirm the focus on hard assets and stability hedges. Gold performs best, with an average return of plus 18.9%.
Oh.
Copper at plus 6.7%, and stocks at plus 4.9%. This just underscores the necessity of that long gold trade in a newly disordered world where political stability is eroding. We've detailed the entire political strategy, used massive stimulus and aggressive deflationary energy policy to engineer a pre-election boom. But every plan, especially one this audacious, has a weakness. Wu identifies the single largest economic risk that could derail this entire political apparatus, the Achilles heel.
A collapse in equity markets, specifically centered on the highly valued AI theme.
This is the administration's Achilles heel, precisely because their entire policy hinges on maintaining a perception of soaring economic prosperity and a wealth effect. Wu warns that current U.S. stock market valuations are dangerously high.
Approaching the extreme levels of the dot-com bubble.
Exactly, the late 1990s. And while valuations alone don't cause a crash, they create the necessary tinder for one.
And the U.S. government has developed this structural dependency on high valuations that makes a crash politically and fiscally catastrophic.
Absolutely. The fiscal dependency is critical. Capital gains tax, the tax collected on realized investment profits, is a massive and very volatile component of federal revenue growth. If the stock market were to suffer a sharp, violent adjustment, say a 20 to 30% drop,
it would not only trigger an immediate recession via the collapsing wealth effect,
but it would also drastically worsen the already precarious fiscal deficit situation by just slashing tax revenue. This would instantly pull the rug out from under the stimulus plans and erode public confidence beyond repair.
So where is the most acute vulnerability concentrated? Why is the AI so central to this risk assessment rather than just general market overvaluation?
The risk is highly concentrated in the AI vulnerability. Wall Street consensus is widely forecasting another 50% growth in AI-related capital expenditure in 2026. This is already priced into the equity of the key players.
But that consensus is fragile.
Very fragile. Rising competition among models, physical hardware, bottlenecks power, cooling, fabrication, and maybe most importantly, these lingering questions regarding the actual future return on these massive capital investments. All of it makes this theme susceptible to a sudden correction. The entire narrative is priced for perfection, and perfection is rarely delivered in technology cycles.
What specific event, then, would be the trigger for this violent adjustment that threatens the political timeline?
The triggers are specific and binary. Wu suggests that if financial reports from major tech companies, he names Microsoft as an example, due to its deep integration into the AI capex cycle, if they show any signs of slowing growth.
Or if retail investors stop buying the dips.
Right. Or if that vital retail investor base stops its habit of buying the dips the minute the market shows weakness, the market faces a violent adjustment. That sudden negative adjustment would directly threaten the administration's core political agenda by destroying the wealth effect and triggering immediate fiscal alarm bells, potentially before that critical September 2026 window.
And the market sentiment data we have suggests extreme emotional positions right now, which confirms this high-risk environment. We are not operating in a rational mid-range market, are we?
The data points confirm maximum risk positioning and extreme emotional conflict. The bull-bear indicator already hit a maximum sell signal extreme of 9.0 in December. This is historically a strong warning sign for an imminent correction.
But the contradictory data is even more compelling.
It is. Cash allocation in the Global Fund Manager Survey is at a record low of 3.3%. That means fund managers are fully invested, fully risk-on, convinced the boom continues.
But then you have these massive inflows into cash money markets, which suggests institutional uncertainty is through the roof.
That's the emotional contradiction defining the market. Cash money markets saw an astounding $148.5 billion inflow in the first week of 2026. It was the third largest single-week inflow ever recorded. This simultaneously shows institutional uncertainty and extreme volatility.
So what does that mean?
It means professionals are holding minimal cash in their portfolios. That's a 3.3% figure. But they're pouring record amounts into money markets, waiting on the sidelines for a crisis or a clear entry point. This combination of highly invested professionals and massive cash reserves demonstrates an extreme, emotionally charged market position that's ripe for a violent move in either direction.
Threatening the stability the administration desperately needs.
Precisely. What a profound and frankly alarming deep dive into the intersection of political desperation, aggressive economics, and the resulting erosion of global order. To summarize for you, the overriding theme of 2026 is one of political desperation, leading directly to massive, coordinated economic interventionism. The strategy is clear. Suppress interest rates via targeted QE, aggressively slash gas prices via geopolitical maneuvering, and inject targeted stimulus checks to secure a voting advantage. The intended outcome is an engineered boom. The unintended but predicted consequence is the end of geopolitical stability and a transition to a power politics era. And the essential trade-offs for the investor reflect this duality. You have to trade the political engineered economic boom by rotating into cyclical values, small and mid caps, banks, real estate, and by positioning long bonds because of the political necessity of QE.
While simultaneously hedging the disorder.
Simultaneously, you have to aggressively hedge the geopolitical disorder. And that means the core safety trades are short emerging markets, long defense stocks, and crucially, long gold. The focus shifts entirely from parsing the Federal Reserve's inflation mandate to reading the White House's political needs and timing.
Absolutely fascinating and deeply disturbing in its simplicity. We're left with a final provocative thought for you to mull over, one that speaks volumes about the political engineering we just discussed in the stimulus section. The U.S. administration's strategy hinges on using revenues collected from tariffs, which are economically a tax on imports often borne by consumers, to fund stimulus checks, and then bundling this with popular social spending like Obamacare subsidies.
This raises the question. If a tariff tax is packaged procedurally and rhetorically to directly benefit low and middle-income Americans with a tangible cash rebate, does that fundamentally change how voters perceive the political viability and the economic costs of global trade wars?